According to Wall Street Journal, over 10 million brokerage accounts have been opened through the first half of this year alone. Now, while day trading is not new, historically its practices were limited due to the high cost of commission fees. But with the surge of the internet, electronic trading platforms, and discount brokerage firms, individuals are now able to trade 24 hours a day, 7 days a week with low commissions. This has revolutionized trading, enabling anyone to trade whenever and wherever. But in short, trading has become increasingly popular even amongst casual investors. And in today's video, we're gonna go over the tax implications of day trading and how one small election on your tax return can make a big difference in the amount of taxes you pay. Let's dive in. Hidden among the countless rules of the Internal Revenue Code lies a regulation that extends huge tax advantages to taxpayers, but many professionals are just unaware of it. This regulation, known as the market-to-market election, is underneath Code Section 475F. In short, if an individual makes this election, he or she is able to treat the losses from the sales of stocks and security as ordinary losses, able to offset all forms of income. So we're gonna go into what this mark-to-market election is. But before we talk about some of the benefits that you can receive, we need to understand how day traders are taxed. Now, in order to understand how investors are taxed, you need to understand what type of traders there are. There are 4 different categories of traders that we'll be talking about today, and some of them you might already be familiar with. The very first type of investor that we're going to discuss is the dealer. A dealer is a different type of day trader. They're holding stocks and securities for a different type of reason than an investor. If a taxpayer is considered a dealer, Section 1236 governs the treatment of the taxpayer's gains or losses from sales and securities. Rather than treating the sales of securities and stocks as capital gains or losses, the dealer treats the sales of securities and stocks as ordinary gains and ordinary losses from business transactions. Now, a dealer makes money by serving as a middleman. They're really a market holder. If you're a dealer, you're holding stocks and securities for different reasons than that of an investor. Your goal is to make a gain off selling those stocks and securities. But when you sell the stocks and securities, the transaction is not considered you selling a capital asset. And so the treatment of you selling the stocks and securities is considered a business transaction, which means you are receiving ordinary income, and which means any losses that you experience as a dealer are categorized as ordinary losses. The income that you receive as a dealer is going to be reported on a Schedule C, and you'll carry your business expenses as being a dealer on Schedule C. You are truly a business owner in the eyes of the government, and in return, you get to take 100% of your business losses. We're going to talk a little bit more about what an investor experiences that might be different than a dealer. Now, if you're someone that is an investor, you're subject to the normal federal capital gains rates that you are probably familiar with, long-term and short-term gains. But we want to understand a little bit more about how an investor is limited from a deduction standpoint. Investors do not receive the same tax treatment as dealers or as traders. And part of the reason why is because as an investor, when you are making a transaction, selling a stock or a security, you are selling a capital asset. And as a capital asset being sold, you are subject to the capital gains rules. The capital gains rules means that for a loss, you are limited to only being able to claim up to $3,000 in losses against your capital gain income. So a lot of those who are investors who are not dealers experience higher tax bills if they have taxable income due to the fact that they're not able to claim more than $3,000 in losses. In addition to not being able to claim past the $3,000 loss limitation, investors are not able to take business deductions that dealers and traders can take. These business deductions include a home office as well as retirement accounts. If you're someone that's an investor and you open up an investment account, you cannot establish a 401k or a retirement account and make contributions to this account because you do not qualify. In addition, if you spent money on programs, your own computers, keyboards, keypads, and any other electronics that go into your office space, these items are no longer deductible if you're an investor. So understanding the key difference between being a dealer versus being a trader versus being an investor might save you some money on your tax returns come year end. So let's go into what it means to be a trader. And now for today's sponsor, Wealthfront. Investing is a huge part of setting yourself up for financial success, which is why I'm excited to bring Wealthfront to you. Wealthfront is a well-designed app that makes investing easy. And the best part is that they do tax loss harvesting, which is like a game changer for anyone who knows how to track tax loss harvesting. It can be a very cumbersome thing to do, and this program will track it for you. Now, if you're new to investing, the best part is you don't have to know much about investing because their expert design software handles everything for you. That's right, they'll build a portfolio designed to maximize returns while minimizing your risk. They'll manage it for you so you can set and forget it. All you need to get started is $500. You can visit the link below to get a special promo code, and they'll even manage up to $5,000 for the rest of your life. Visit the link below to get started. Let's jump back into this video. If you're a trader, then you are someone that is selling stocks and securities very similar to that of an investor, but there are some key aspects that makes what you do completely different. Typically, traders are making quick transactions. Sometimes traders are making transactions daily, within the same minute, within the same hour, or maybe they're making trades every week or every couple of months. They're doing swing trades. But one thing is for certain, when you have made the election to be treated as a trader, one, you will still be limited to the same loss limitation rules as investors. You are only able to claim up to $3,000 in losses. But being that you are a trader, you are able to claim business deductions. And these business deductions include your home office as well as your home office equipment. I have tons of day traders that got into day trading last year during the pandemic who were already W-2 employees, and because of the fact that they were making the election to be day traders, they were able to write off their home offices, their laptops, their keyboards, and the expensive programs that they were spending their money on to learn how to day trade. And that ended up serving them, especially if they ended up having a lot of expenses. I want you to be able to know these differences so you're not spending money knowing that you can't get some of that recouped if you were to write it off. The big difference though between what a trader gets to experience and what a mark-to-market trader gets to experience is the losses. So what we're gonna do is we're gonna talk about what the mark-to-market election is and how you as a taxpayer can make this election to end up saving you on your overall tax bill. Under the rules of Code Section 475F, those who have made the mark-to-market election have deemed to have sold all of their stocks and securities for their fair market value on the last business day of the tax year. In other words, every position in the trader's trading account is marked to market and is deemed to have been sold at that price at the end of the year. And as a trader, that might be something that serves you. Yes, you're claiming a lot of income, but you're also being able to experience 100% of your losses. Let me give you an example where this could end up serving you. I had a taxpayer who came to me last year in the year of 2020, and he had about $200,000 in taxable income. Due to the fact that he was getting into day trading during the pandemic, he experienced a lot of losses early on. He had over $100,000 in losses. What we did was we made the mark-to-market election on his day trading, treating 100% of his losses as ordinary losses. Since he was at a loss already and he had $100,000 in losses, he used the $100,000 in losses to offset his $200K in W-2 income working at his day job. And that immediately reduced his taxable income down. Now, this is an advantage that you can have just by simply knowing information, but it doesn't necessarily mean the market-to-market election is for everybody. And it doesn't mean that you should become a day trader just because you hear about the market-to-market election. One thing to know is if you decide to go into investing, you have a choice. You can choose to still passively invest if you'd like to, and you can become a day trader. Underneath the Code Section 475 D3, you are able to segregate your investments that are held onto for investment purposes and those investments that are held onto for day trading purposes. If you want to experience ordinary income and ordinary losses on your day trading, then you can, while also being able to nurture and grow a portfolio of stocks that you wish to hold long term, being able to benefit from both areas of the tax code. And this is something that you might want to put together as a part of your tax plan as you build your wealth strategically. I've enjoyed creating this video on day trading for you guys, but there's tons more information to learn around day trading. If you guys are interested in learning more about this video, feel free to like, comment, subscribe, and visit the link below to schedule a complimentary consultation with my tax team. I look forward to seeing you on the next video. Cheers.